Good morning, ladies and gentlemen. If those of you who have watched us know that we're somewhat behind, we are going to, in fact, try and accelerate this a little bit. We have agreed amongst ourselves that we will each speak for about 3 to 5 minutes to allow for questions from the floor, because that's obviously by far the most interesting aspect. I'll start off by saying that the discussion this morning, which is the impact on customers from changes of the financial regulatory system, is, of course, hugely important. It's what, in fact, this panel is all about. And thinking about customers of financial services is not only an important part of my role as the chairman of the Advisory Council of TheCityUK, but also in my day job as chairman of Lloyds Banking Group. Our 5 eminent panelists are all intimately concerned with the future of the UK's financial system and will be providing a welcome perspective. In viewing perhaps what they will be talking about, I will also be putting a few questions, posing a few questions myself. First of all, to the panel. To my left, Matthew Fell, who's the Director of the Confederation for British Industry, and Martin Wheatley, the CEO Designate of the Financial Conduct Authority, and the far left, John Howard, Consumer Affairs Expert and Special Advisor to the consultancy Huntswood. My right are Mark Neale, CEO of the Financial Services Compensation Scheme, and Lord Fall, who is the Chairman of the Workplace Retirement Income Commission and former Chairman of the House of Commons Treasury Select Committee, a committee which he raised to new standards of discussion and participation by bankers, if I may say so. A more fulsome description of their backgrounds is contained in your reference material, which you have been given when you came in. At the TheCityUK's spring debate this year, Claire Spotswood, a member of the Independent Commission on Banking, chaired a panel that considered the future of the financial services industry in the UK. We've now all had an opportunity to read the final report and to digest the proposals of the ICB. Our panelists might like to reflect on how these will shape the UK banking market and to anticipate some of the changes that customers may experience arising from it. Preserving a dynamic, affordable and competitive market for finance was one of the requirements set for Sir John Vickers and his 4 colleagues, along with ensuring that taxpayers are not liable for future bailouts. It will be interesting to hear from our panelists how well they think these objectives have been met. Of course, the changes to the UK's regulatory system are not limited to the proposals put forward by the Independent Commission only. We are also anticipating a shift of the work of the Financial Services Authority into 2 separate bodies for prudential and conduct regulation. These will work alongside the new macroprudential regulator, the Financial Policy Committee. The PRA and FCA will continue the work of the FSA, and the FPC, the Financial Policy Committee, will have new powers for macroprudential regulation. Though these committees' toolkit has not yet been set out in legislation, a number of powers with direct bearing on customers has been proposed, including counter-cyclical capital buffers, leverage limits, high collateral requirements in times of high lending, quantitative credit controls, and reserve requirements. It will, of course, be crucial that alongside these tools, transparency and accountability are embedded in the Financial Policy Committee's work, including a regard for striking the correct balance between stability and economic growth. The changes to the regulatory architecture in the UK are met by a new system of European supervisory authorities and a raft of new legislation from the European Union that will impact the UK. Our experts in the panel may wish to comment on how European initiatives will impact customers in this country. Ensuring the availability and affordability of finance, preserving contestability in the market, and creating a credible resolution regime backed by the Financial Services Compensation Scheme will be the pillars of ensuring that customers are well served. So without further ado, let me turn to our distinguished panelists, and I will take them in order from the right-hand side. First to John McFall. John.
Thank you, Sir William. Good morning, everyone. I'm delighted to be here. I will keep to 2 minutes. First of all, can I say that with the new system, the architecture doesn't really matter. it's people working together. That was the lesson of the financial crisis in the past, and it will still be the lesson in the future. And the question I ask is, are there interstitial areas in this architecture? Absolutely. And if there are interstitial areas, then people go down those areas. So that when they come to, for example, the Treasury Committee, and they're asked, did you do your job? Everyone says yes. Well, how did we get into this mess as a result of it? It wasn't my fault. So who's in charge? And that is the kernel, that is the main issue of the whole thing. So forget about FCA and PRA going to do a fantastic job. At the end of the day, it's about people, and that's the issue. Secondly, on the issue of consumers, consumers are weak in this system. And they're even weaker in Europe, by the way, So I would suggest that if consumers and industry get more of a balance, and that's one hell of an objective to get, then it could be a win-win situation both for the industry and for consumers. And the definition of consumers that's been put out in this draft financial services bill is so wide. It goes from hedge funds to your granny getting into the local Halifax to get a bond. So something needs to be done in that area. 3 issues to look at. The FCA overall objective, that's got to be looked at. The FCA overall objective at the moment is confidence in the system. But I suggest to you, didn't we all have universal confidence in the system right up to August 2007? So that aspect has got to change. In terms of competition, Vickers is right to ensure that that gets put in. And also on the issue of warning notices to companies, that there is a kickback against these warning notices. But if you look at the issue in the Food Standards Authority, you know, when there's a defective product in supermarket shelves, it's taken off the shelf and there isn't any hullabaloo as a result of it. And if I remember correctly from talking to Martin, when they give out warning notices, it's only in 5% of cases that there is nothing further done in terms of penalties. So 95% of cases, then there is something substantial. So I think they have got to look at that. I was privileged to be at the Today programme lecture by Bob Diamond on Thursday evening. Very, very interesting on that. Bob Diamond said, strong banks need strong regulation. Witnesses who came before the Treasury Committee in the past said that if you have a well-regulated system, then you can have good competition. I think it's important to keep that. He also said something I've been bashing on about, there's a need for culture and ethics. He defined culture as behaving when no one's looking. But I think if banks established a culture and ethics committee, I think that that would be a step forward. And by the way, I don't believe that culture and ethics can change overnight. I think it's a long-term issue in terms of changing. But against the background against which we are in the world today, I think that that aspect is important. The too big to fail, Sir John Vickers came before the Joint Draft Financial Services Bill Committee, admitted that his report would not solve the too big to fail. Financial Stability Report came out and said the top 29 banks, they're not in a fit position for too big to fail. So a huge issue yet for the issue of too big to fail. Lastly, Bob Diamond said the bankers need to be good citizens, but he believes no one will believe them when they say that. That's a big challenge for the financial services.
Thank you, John. Wonderfully concise and very, very interesting. Can I turn to you now, Mark?
Wynne, thank you very much, and hello, everybody. I think the starting point for me is the drive that we see in the government's reforms of financial regulation towards a world in which financial services businesses, even the biggest, can fail without having adverse impacts on overall financial stability. I think that that means that it is more important than ever to have an effective financial services compensation scheme in place which can protect consumers when financial services businesses do fail. And that is our central mission. I don't think the Vickers report substantially affects that. We saw in 2008 that pure retail banks are perfectly capable of getting into difficulty on their own. So there will continue to be a role for the financial services compensation scheme. And it is critically important that we are able to pay out depositors in banks quickly and reliably. And we now have that capability in place and have used it in anger this year with a number of small credit union and bank failures. Final point from me, I think it is also very important, not just that the capability that we have in the Financial Services Compensation Scheme exists, but that consumers are aware of the existence of the protection we provide and also aware of the limits of the protection that we provide. And that brings me on to the issue of competition and regulation. Competition is terrific where it drives down the price and improves the quality of financial services which are straightforward and do for citizens what it says on the tin. It is more problematic when competition drives in the direction of greater product complexity. The Financial Services Compensation Scheme can protect people against risks they were never told about, but we can't protect people against risks they were told about but didn't understand. And it is really critically important in thinking about this issue of regulation and competition that we bear in mind the need for products to be kept straightforward so that consumers understand them and above all understand the risks that they're taking on when they buy them.
Terrific, which leads very naturally onto Martin and his new role which he's just taken on in the last month or so. Martin.
Thank you very much, Wade, and again it's a pleasure to be here and to re-engage with so many old friends from London after my time away in Hong Kong, learning about how to treat consumers, which is a very different philosophy from how we will treat consumers in London. I'm going to make 5 points. First and foremost, the point that's come up several times this morning is good regulation, bad regulation. Nobody sets out to make bad regulation. Believe me, it's not in the interest of regulators, it's not in the interest of the industry, it's not in the interest of politicians. It sometimes ends up as bad because we forget some of the consequences of the actions that we take. And you can avoid, not all of those consequences, but by and large avoid those consequences by staying close to the set of people who you are regulating, the industry, the consumers, the groups that represent them. So the first point I'll make is that nobody sets out to make bad regulation. We avoid that by being close to the people that we regulate and close to the people that they serve. The second point, we're moving to a new structure. We're moving to a structure where we'll have the FCA and the PRA. It's critically important that we don't throw away the lessons that we've learnt over the last 10 years and the lessons that we've learnt from the FSA. So we've been through a tumultuous period. It's been a very, very difficult period. The government has decided that we'll move from the FSA to a new structure, but let's not forget the lessons that we've learnt as the FSA going through that very difficult period. The third point I'd make is that the consumer and the traditional philosophy of protecting the consumer has failed. And the traditional philosophy is that if you give the consumer information and you give them all of the information about the product and you try to regulate the distribution channel, the conduct of the bank, the IFA, the broker, then the combination of those two things will lead to good outcomes. And the reality is over the last 10 years, we have not had good outcomes. We've had significant amounts of loss. And hence the concern that now we need a regulatory structure that will intervene more and earlier where those failures are being seen to occur. Now that intervention doesn't have to be the draconian element, the draconian end of our powers, that we intervene to remove products from the market or we intervene to remove players, actors from the market. You may have seen last week that we published some thoughts on how we thought, for example, structured products should be managed and organised and structured by the people who create those products. And most of it's common sense. You design a product with your customers in mind, you target a particular set of customers and you model the outcomes and then you watch what happens. And if what you see you don't like, then you do something about it. Now that's ideally what should happen. Our role steps in when that doesn't happen properly. The fourth point I'd make is a point that's already been made, which is consumers is a very wide group, and it ranges from small retail investors to hedge funds to exchanges and clearinghouses. Obviously, different groups need a different degree of protection, and we will be proportionate in our response depending on which of those groups that we're dealing with. And the final point I'd make, and all of this comes down to, at the end of the day, the single point that actually regulation has to be about balance. It has to be about, yes, protecting consumers, but allowing our industry to innovate and develop. We've heard this morning about how important the financial services industry is, not just for the UK, but for Europe and the world. Regulation must go hand in hand with the development and growth of our financial sector, and therefore the recovery of our global economy. Thank you.
Terrific. Thank you very much. Matthew.
Swin, thank you. Good morning, everybody. Three short observations from me. First, when we're defining the customer, a point you'd expect from the CBI, we should remember that business is very much a part of that. Inevitably and rightly, there's been much political focus on the consumer end of these reforms, but we should also be clear what business wants from the financial system: stability to ensure that the funds it relies on are available at all times, a preoccupation still with ensuring that lending is available to help drive economic recovery, and then third, restoring trust and getting back to relationship banking so that businesses can feel they can have a good dialogue with the people that are providing them finance. Second observation, Martin, you just talked about balance. That's inevitably and rightly very important, this trade-off, if you like, between stability and growth. Where do we draw the right line there? We should be very clear that stability, much as we prize it, does come at a cost, so it's very important to understand the costs and the benefits in getting that balance right, and remember that where growth is going to come from in the coming years will be driven by business investment and by exports rather than domestic demand, so we should be making sure that we do everything we can to support those objectives and making sure that financial reforms support both of those. And then thirdly, in the UK, Win, as you said, the Banking Commission has inevitably been much in the spotlight here, and in a sense marks the UK out from the rest in terms of where we're heading on that agenda. Business is very much up for reform, but we're also mindful that the UK is going it alone in this territory, and our preoccupation there is what does that do for the cost of lending to businesses relative to their own international competitors, and what that does for the growth and the exports agenda. The more you require banks to hold capital, that increases the cost of lending, and our initial analysis from the ring fencing proposals suggests that that will be detrimental in some way to the ability to access products and services, particularly at the small business end of the banking market. So we should be very clear and understand the implications of these reforms and get the detail and the timing right so as not to jeopardise the economic recovery.
Thank you very much. Again, very succinct. Lastly, to you, John.
Swin, thank you. Is it any surprise that with such an eminent panel, by the time it gets to me, all the best points have been made? But I will...
Surely not.
I'm not going to stop there, though. I am going to add a few of my own. The regulations and the change in the structure, I think, are really laudable, and a number of aspects of the regime, which Martin is going to be policing, I think will really make a difference. And the one that I particularly pick out is the product intervention power. I think that the scandal over PPI wouldn't have happened if that sort of a power had existed in the past, because we would have spotted that there was a problem and the regulator could have intervened much earlier and got everybody off the hook. The problem was that once PPI got into the marketplace, everyone saw this as a great product because it was producing superb returns. But once you realised there was difficulty, how were you going to stop selling it when your competitors were continuing? So I think that that product intervention power is going to be key to improvements in the marketplace in the future. The one thing that it does require, though, on the part of the regulator, Martin, is real courage to exercise it, because you may well find that the marketplace is saying, no, this is great, this is right, but you've got to have the courage of your convictions when it comes to it to intervene and don't make sure we don't get into the sort of predicament we got into with PPI. The other point I'd really like to focus on, just to keep this brief, is I'd like to follow up with Lord McFall's comment there. And Bob Diamond, I wrote his quote down: the best way to create sustainable shareholder value is to focus on the interests of the customers, clients, and the communities that we serve. To the question, can banks be good citizens? The answer must be yes. And I've made this suggestion in the past, and I think that it's worth making again, that the way I think for the major institutions to be able to meet that promise is to set up sort of public interest groups, boards, if you like, which report into those organisations and provide the sort of feedback which I feel many boards don't get at the moment. I think there's a real disjunction, if you like, with the way that boards view what is going on and the way the public views what is going on. I know that TheCityUK has done a lot of research recently about all of this, and what is very clear is there must be much greater communication over what the banks are doing to the people in this country who use those services. That's broken down. And I think that also boards in the major institutions need to have the input of what the public perception really is in the issues that matter, and to set up the sort of board or group that would be consisting of consumer or public interest members would really enable that bridge to be crossed. Many consumers just don't understand what the banks do this day, today. And if you have a group in this sort of board who can be briefed and educated into what the banks and financial institutions are doing, it will really help to bridge that gap in what public awareness is all about. And just finally, Sir Wynne, I'll indicate how this sort of idea is spreading now through companies and through our society, because from yesterday's Sunday Times, there's an advert for Southern Water. They are recruiting a chair of a customer challenge group. And the chair of that customer challenge group, their responsibilities will be for reporting to the water industry regulator and Southern Water's board on the quality of the company's engagement with customers and stakeholders and the acceptability of its plans. So there is a company which is embracing this idea to import that sort of view and get that sort of advice so that it can come to what I would suggest might well be better conclusions, and that would enable that company to be able to do what Bob Diamond is identifying there, that our financial institutions need to do, to be much more in tune with what the public feels is important, and for the public to get a better awareness of what you are all doing for the sake of the country.
Thank you very much, John. That last comment, of course, of John's does speak to something that he's been talking about for some time, and that is the public identification with problems or opportunities, but also for the boards somehow, the boards of public companies that run financial services, to be very much more aware of those. Now, we look forward to questions from the floor. If you might, in fact, identify yourself, and also if you have a particular view as to which one of the panelists should answer the question, let me know that. If not, I will, in fact, direct the question to who I think is the most appropriate. So, where's the first question? Yes, gentleman there. Is there a microphone coming to you? Coming from behind you.
Sydney Myers, Berwyn Leighton Paisner. My question is directed to Lord McFall and concerns the issue of the warning notices, which, as you say, is a very controversial issue. You said that, according to the FSA, 95% of cases result in a substantial penalty. I'd be interested to know whether that's right. It certainly doesn't reflect the number of cases that are overturned in part or in whole by the tribunal, which seems to be rising. Isn't it a bit like saying that we should bring back the death penalty because the jury gets it right in most cases and we don't really have to worry about the ones where they get it wrong because it's really not that many? Surely a firm which is accused of misconduct has a right to defend itself before its reputation is destroyed by the press and in the court of public opinion. Is that just a very old-fashioned lawyer's view?
No, I don't think so. By the way, I'll pass you over to Martin, because Martin and I were sitting in the foyer 10 minutes ago, and he gave that very figure to me. Correct, Martin?
Yes, that's right.
Exactly. So there you are. So I always get
You would never disagree with John on the public panel. No, I think that's right.
But the point is this, that, I mean, I've seen too many examples as chairman of the Treasury Committee in bad selling. Let me give you PPI. PPI, I was a customer of one of the big banks, pretty near Bob Diamond, in 2005, and I crashed my car in the general election. to the delight of some taxi drivers in the local roundabout, my area. However, I went in for a £12,000 overdraft to buy another car as soon as I was elected. And I went into the Victoria branch of Barclays. I said, looking for 12,000. OK, sir, we'll give you that money. But PPI, would you like PPI? I said, no. They said, why? I said, listen, I've just been elected across the road. I said, and see if I don't turn up for the next 4 years, I get paid. It doesn't matter. Yeah, but it's rather folly, sir. I think this is a good idea. It was followed up by 8 separate letters from Barclays to me over the next 2 or 3 months as to why it was silly for me not to have PPI. The Treasury Committee reported it in 2004, I think, to the Competition Commission, and it's gone on, lumbered ever since then, and people have sold it, and it's done people badly. Split Capital Investment Trust, structured products, and that was allowed to go to the extent that the Treasury Committee ensured that we prosecuted £200 million for people who'd been sold them. And when the architect of the structured product came before us, I think it was a certain Dottie Thomas who came before the committee, I said, Dottie, when you devised this product, did you understand the implications of it? Oh, he says, I did understand it when I was devising it in the office, but I didn't understand the implications when it went out to the market. Now, the pain that has caused so many people, and I had immense number of letters on it, means that you're having a product that's defective and you're allowing it to be sold for years and then people get punished. That's a daft system, and it's unfair on the customers who are having that. And if the Food Standards Agency can take tins of rotten tomatoes off the shelf and it doesn't do any harm, why can't the financial services industry, by the way, which has got the best and the biggest brains in the world, why can't that devise something fair and ethical to consumers?
Martin, would you just, I'll come, yes, thank you very much. Martin, would you just like to say something about this sort of court of public opinion type of thing? How does one actually deal? How will you deal with these kind of abuses that, or what you might be seeing as abuses before it actually gets to a decision that this was either right or wrong?
Okay, I'll deal with that, but maybe I could come back to the warning notice issue.
Yes.
The proposal is simply that we bring our industry aligned with the common practice in civil and criminal courts that seems to work for the rest of the UK. That when charges are laid, charges are laid. They may result in a penalty, they may not result in a penalty. In our cases, most of the time they do. If I can come back to the other point about how we will intervene and when, I think it's important to realise that this is the last of a long chain of actions that we would want to take. So intervening is the last thing we'd want to do. The first thing we'd want to do is to try to make sure that a firm's own product creation guidelines, the way it puts products together, the way it identifies its target market, the way its sales forces are incentivised, are actually appropriate. And that's what most of our effort will go into, making sure that there are appropriate products for the right set of people, that sales staff are appropriately incentivised. If we do need to intervene, and this comes down to the interesting point that was made earlier about evidence-based regulation, it's easy to act when it's clear that something's gone badly wrong. It's much more difficult to act when something may go wrong. And the essence of the test for the new regulatory regime is to how we use our powers where we haven't got the 100% evidence base that we will have today and that we've traditionally operated on. The way the system is designed is that we effectively will intervene. We've then got a year in which the product is suspended, but we then have to go out and make rules and consult with the industry. So effectively the check on us will be what happens in that process whereby we articulate why we have a problem with the product, we articulate what a different approach would be, and then we consult with the industry on that different approach.
Terrific. Yes, up there.
Thank you very much. Lawrence Baxter, Chartered Insurance Institute. Martin, I found your comments very, very interesting. Those 5 points you made about financial regulation, and I mean, it needs to balance good regulation and bad regulation, mustn't throw away lessons from the FSA. More importantly, the diversity of consumers, and also the importance of balancing regulation and growth. A lot of the debates we've been seeing, especially in the financial regulation space, have been quite vociferous when some of those 2 or more of those very laudable principles crash into one another. I mean, you get a very strong arguments on, say, for example, consumer protection, balanced against equally strong arguments about the impact on growth. It's in some of these areas, especially in, for example, retail investments, it could only be characterized and described as a three-dimensional air war going on, very much around those principles. So how are you hoping to sort of prioritize those areas and to be able to balance those very, very, well, quite important and equally persuasive arguments? Thank you.
Well, if I may, clearly the new structure will clarify some of the clashing objectives. So in the past with the FSA, which had the overall prudential responsibility for firms and conduct responsibility, there would be occasions when you would have a clash between those two within a single organisation. Now what we're doing with this structure is saying, at least for the largest firms, the prudential requirement, that sits with the PRA, which will be with the Bank of England. The conduct part will sit with the FCA. So one of the sets of conflicts gets separated out because each organisation will have clear objectives. But there's still scope, as you say, for conflicts within the conduct regulator. And a lot of that will come down to how the objectives for the regulator ultimately get drafted. So we will have responsibilities for protecting consumers, but we will have to take account of the impact of that on competition. And that's how it's drafted at the moment. That may change. The short answer is, how do you reconcile that? Well, with lots of heart wrangling and scratching of heads and trying to put data together. But it's a conflict that you can never ultimately get away from unless you were creating a very monolithic single monoline type of regulator which only has consumer protection as its responsibility. And if you have that, then you simply externalize the conflict to another organization. So the truth is that these conflicts will always exist. You can either internalize them or you externalize them. One of the sets of conflicts has been externalized between the PRA and the FCA. The examples you give will still sit within the structure of an organization, and it will come down to scratching of heads and looking at data and talking to the industry.
Do you want to say something?
Well, I'm just broadening it out even beyond the sort of regulators and supervisors. I think part of the way that you go to addressing the question is to be just absolutely clear on what piece of either regulation or intervention, what are you trying to tackle through it. And it seems to me, if you look at the different sort of pillars that have been in place, better, tougher, more sophisticated regulation and supervision to spot and tackle emerging problems, capital, so you've got the necessary buffers to withstand problems. And then I think the sort of reform that's not been talked about as much this morning is around this sort of idea of recovery and resolution. And it seems to me if you can get that working properly and proper confidence that that will do the job when it's needed to do the job, that will actually sort of help to address a lot of the other calls for further reforms where we need to be clear what are they designed to do, lay it on top of one another.
Okay. Question over there.
My name is Jeff Cook. I'm from Jersey Finance. My question, though, relates to experience earlier in my career with HSBC when I ran their mortgage, IFA and wealth planning business in the UK. And I'd like to ask a bigger question, really, about cause and effect, because we're talking, I think, a lot about the symptoms of dealing with problems when they've occurred or trying to prevent them. But I would pose the question to bank boards. Can you get a 15 to 20% return out of a utility business? And has the core consumer banking operation in the UK been too affected by, on the one hand, investment banking and risk appetite, and on the other hand, the importation of retailers who might have previously sold telephones or fashion, as bank boards sought to bring in sales expertise to try and sustain flagging returns? And whilst ever those pressures are there and the market expects a 15 to 20% return, I would suggest we'll continue to have these problems.
Thank you very much. Perhaps I'll take that question, since I have served on a number of bank boards. I think 15 to 20% is going to be very unrealistic for the future. I think it's very unlikely. The kind of capital requirements and liquidity requirements that are demanded. And when you hear now of CEOs in various banks, Bob Diamond, Stuart Gulliver, there are people who talk really very much more in the low teens, and I think there will be some difficulty even getting there. So I think the returns on banking are going to come down. They're going to be much more, in my view, in the area around just slightly above cost of capital for the better banks, and some of them won't, in fact, be able to make that. Partly that will be because the complexity is going to be, to some extent, if not outlawed, is going to be not taken by the market. The market will, in my view, reward non-volatile returns far more highly than volatile returns, and I think that will change the business model. This will take some time, I believe. It won't be it won't be right across the board, but I think if one talks in general terms, your point is very well made. John, I saw you nodding.
No, I agree with that aspect. With it, and Bob Diamond and Stuart Gulliver before the Joint Financial Services Committee last week in Parliament, and made that very point. Noted the speech that Andy Halden of the Deputy Governor of the Bank of England made when he was talking about should it be return on assets rather than return on equity, and I think that's an issue that we should discuss. But I think the retail banks will be seen more in the utility phase.
Yeah. Right. Question over here, straight ahead. Yes.
Tom Smith from HSBC.
HSBC to the fore.
Yeah. I was going to ask a question about the upper tribunal. At the moment, the tribunal can overrule a decision of the regulator, but under the draft Financial Services Bill, if enacted, the tribunal will only be able to send a decision back to the regulator for reconsideration. In other words, the tribunal will lose its power to overrule the regulator. I think that, unless the legislation's changed since the last time I read it. So I was just going to ask if you think there are sufficient redress mechanisms for firms in light of that.
Who would like to answer that question? Martin, do you have a view on it?
I don't. I didn't realise that was the change that the legislation was proposing, so I can't comment on that.
I can't either, I'm afraid, but there may be somebody else in the audience who can. Perhaps we can have a quick discussion over coffee. There was a question up there, right in the back, is that right? No? If not, there's one here.
Thank you. Richard Metcalf, International Swaps and Derivatives Association. My question is primarily aimed at Mark Neale. Given that there's quite a variety of structured products in the market, some of them with admittedly complex mechanics which actually reduce risk, and given your comments, which I understood to be about how difficult it might be to protect investors against risks they don't understand, do you have a preference for broad but arguably relatively crude risk indicators, given the sorts of issues one's run into with credit ratings in the past? Or do you see a lot more promise in where European legislation appears to be heading towards a key information document, albeit a concise one limited to 2 or 3 pages?
Well, I don't think I have a preference on either thing because I'm not the regulator, but let me make a point about structured products. I think there is a paradox. I think the industry is increasingly, for honourable reasons, seeking to provide consumers with products that provide a certain return. But in uncertain markets, and markets always will be uncertain, producing a certain return is more or less bound to involve a degree of complex financial engineering. At the very least, it's likely to involve the embodiment of some counterparty risk in the product, and it may involve the consumer taking on other long-tail risks which the consumer is not well placed to judge. So my point really is that we, the industry, need to take on board the impact of that complexity on consumers in thinking about the regulatory structure that we want. And if, to give you an example, we were not able to protect all the investors in Lehman-backed structured products because the counterparty risk in that product was in some of the marketing literature set out for the consumer.
I think I think it's an extremely good answer. I think if you want to have, and this is what I think a lot of financial companies, of course, are striving for, is to protect the consumer. That does actually lead to complexity, and complexity needs to counterparty risk. And I think Martin and I have discussed this in the past. I mean, it's a really difficult problem how one is going to deal with that, and I think it's something I'm sure that you will be thinking about.
Yeah, yes, very much so. And but the idea, if I can come back to one of the ideas, that you can somehow brand or kite mark particular products becomes very difficult, because that becomes the only judgment. So people structured products to meet AAA because they knew that institutions could hold AAA. And therefore you stopped asking questions about what was behind the AAA.
Yep.
We're seeing it now with UCITS funds, where because of UCITS can be sold through particular channels, we're now seeing hedge funds restructured as UCITS funds. So I think the branding of products with something that makes them look safe is quite a dangerous thing.
John?
I just wanted to say that I think this issue of communicating understanding to consumers is one of the biggest problems that the financial services industry faces, and I think it's very difficult to unravel how to solve this. I think you can start from the premise that if the consumer understands everything about a product, then if they buy it, then that is their responsibility. They've completely assumed the responsibility for it. But if it's so complicated that they can't really understand every detail of it, have they truly agreed with the purchase of that product if something goes wrong? And I think that's a terribly difficult thing to unravel. I was very interested in what Martin said to the Treasury Select Committee last week, because his comments seemed to be shifting towards more of a suitability test, so that you had to convince him as the regulator that whatever the product did, and no matter how complicated it was, at the end of the day, the regulator would be asking you, and expecting you to ask as well, whether the product was suitable for the customer sitting in front of you. I'm not sure that that's any easier a challenge, actually, because you've got to understand so much about the customer sitting in front of you to decide whether it's suitable. But I think this is one of the biggest issues that the industry faces, because the products that you're dealing with so often are quite complicated. It's very difficult to get that understanding over.
We're running late. I'll take 2 more short questions and 2 short answers. To you first.
Thank you. Nigel Waterson, Chairman of the Advisory Board of Now Pensions. This is really a question more for John McFall, I think. The Ambassador kindly mentioned our entry into the UK market on the back of ATP, the Danish Pensions Fund. And I wonder if John and the other members of the panel think that we have lessons to learn from people like the Danes in terms of both the culture of selling pensions and providing pensions in this country and its regulation.
John.
Yeah, Nigel, thank you very much. As you know, I did study for the National Association of Pension Funds on workplace pensions, and I think there's an awful lot to learn from Europe, Nigel. With the flight from DB to DC, largely speaking, people in DC schemes are left totally on their own now. And I think there's a disaster coming up over the next few years on that issue. I think there's a lack of governance in DC schemes. You know, when people in DB schemes, there are trustees. Well, it's not the same with DC schemes. And the complexity in D schemes are enormous that no one can understand from week to week what's happening. So there's, first of all, a need for trustees and governments on that. But secondly, in terms of pension pots, what we're seeing now, particularly with people moving in employment regularly, we have a collection of small pension pots, and there ain't any economic efficiency in that. And Denmark and Holland provide a benchmark for us in terms of larger pots, so that we do have that economic efficiency and better returns for people. Bob Diamond's lecture last week, I remember he said, in terms of pensions, individuals need a return of, say, or pension providers need a return of about 7.5%, to help provide people. What are we getting at the moment? We ain't getting that. So therefore, these times require radical actions, and I think there's a lot to learn there, Nigel.
Thank you, John. Yes, Dan.
Probably a simpler question. This is for John Howard, really. And I was struck by your suggestion that banks need public interest boards, or that would help the situation. I mean, as a member of various boards in my life, it did seem to me that that's one of the jobs of the non-execs on a board, is to think about the broader community and the public interest and the consumers and so forth. So I think if there's a failure, it's perhaps that we don't have always the right diversity, the right mix of people on boards. And certainly, I think that looking after the public interest is much more effective by members of the actual board that's making decisions and monitoring the business than by some separate group. And I would just say, in terms of how a board should do this, particularly for banks, I think it's quite important that bank boards look not just at where the losses are coming up in business lines or product lines, but where the real profits are coming up in these lines, because that's usually an early sign that there may be something strange going on.
John? I wonder which products you're thinking of there. Yes, the non-execs undoubtedly play a part, but having served on a number of boards myself, I know that you can fall into the board way of thinking. It's not what you're supposed to do, and you're meant to be constantly challenging. But I think that the sort of board I'm thinking about would have a different job. And I'm coming back to this point that there seems to be a breakdown in understanding between the community and the institutions. Huge challenge now from the public about what banks do, how much individuals in banks are paid. And I think that this sort of body that I'm talking about will enable that gap to be bridged, because it's a two-way lack of information. I think the public does not have enough information about what the institutions are doing, and to engage the public in a body within the organisation to communicate that will help in that direction. But also, I think, even if you're a non-executive on a board, you're going to be looking at things at a very high level. And I think that the sort of organisation I'm talking about will be able to look at some of the minutiae and to help the board and feed back to the board the sorts of concerns that people have. Just as one example, there was one financial institution that had set up a little group of customers to look at complaints. And before any complaint went to the Financial Ombudsman Service, this group of customers, chaired by JP, who also happened to be a customer, looked at the complaint and they gave what they felt was a really objective view of whether that particular customer they were looking at was being treated fairly. It was still the chief executive's decision whether they rejected that complaint or accepted it, but the very fact that they had that feedback must have given them more confidence that they were being objective about what was fair from a public point of view. It's all too easy, I think, for institutions to think what is fair in their own terms, especially even if you're a non-executive director, without having a real concern, a real understanding of what the public feels is fair. And it's that sort of input that I think that a body that I'm talking about will be most effective.
Thank you very much. I know that there are quite a lot more questions. We could go on. I think very interesting questions, but I think this is the time actually to call it to a close. I'd like to thank the panelists for their contribution, and very much you all for your interesting questions. Thank you very much.